These are the easy chapters. This is stuff that you've already been doing, but there's a bunch of little tricky stuff.
Yeah.
I guess we gotta wait 10 more minutes. You know, we're starting to- I wouldn't mind, but this is gonna be actually going pretty quick. Business expenses. Do you guys know what business expenses are?
No.
Chapter 3.
Compensation, cost of goods sold, interest income, rent expense, taxes. Who's usually here? Millie? Well, Bay was here last week, but I bet. Who knows what Bay's doing? Bay is actually looking to this. He's actually looking at,
Oh, the recording?
yeah. You know, you can get this online if you want it. Any of them, if you want to go back and look at them. But I don't know how you would roll through it if you go, I just want to see that one part he talked about basis. I'll probably give you those same sheets I gave you last time again next week for basis. That's still the best way.
We're still gonna learn that.
You're still gonna, you know basis. You're gonna be so sick of basis, because you're gonna do regular basis when you buy and sell an asset, when you have a like-kind exchange, okay? When you trade stuff. That's what the basis is in the next chapter. But then you're going to corporations. You're gonna go to partnerships and S-corps. All three of those have basis calculations. C-corps are the easiest. Mostly you're just buying and selling stock. You buy it for this price, you sell it for a different price, and the difference is either a gain or a loss. The only changes is if they have some kind of adjustment in between. And we go back to the FIFO, LIFO stuff for stock. Okay, let's go ahead and open up. So we're going to start off activities engaged. Okay. To be a business and take off business expenses, what's the first rule? It's got to be a business. Can't be a hobby. The old rule of you have to make profit 3 out of 5 years shows that it's not a hobby. You guys know that that's not a hard and fast rule. That's what the IRS says, but it's really facts and circumstances. So if I get into a business and happen to have gotten into a business, I had a client that did this, in 2008, got into construction. Then in 2009 and 10, the mortgage crisis happened, the whole world fell apart, stock market went in half, everybody was losing their homes, nobody was building. It was a crummy few years to be in the construction business. So, even though that you're supposed to make money 3 out of 5, he was trying his hardest to make money. So, it's not a cut and dry 3 out of 5. But the rule, what they want you to say for the test is you're supposed to make money in 3 out of 5 years to show that it's not a hobby. But if you're in the construction business and you're out in the hot sun all day, working as hard as you can, it's going to be hard to say that's a hobby. Okay. Expenses need to be ordinary and necessary, reasonable, for services performed, you must have proof that they were actually performed. Why would that be important? Years ago, at least 10 or 15, I had my kids work for me. I made them clock in, clock out. I gave them like close to the minimum wage. It wasn't very high. And I had to write down on a weekly piece of paper what they did for those hours. So that if the IRS goes, no, your kids weren't really working. I had, oh yes they were. This is when they were here. This is what they did. And that, the reason I did that is my dentist went to prison for doing that exact thing. He had a wife and he had kids. Well, his kid was a grown kid and living in California, and he claimed he was working for him here in Hawaii. Hello, he might have been a good, he was like on one of the covers of a magazine, Dentist of the Year. He had it up in his office. He might have been a good dentist, but he was a lousy accountant. Hello, we're just getting started. Perfect timing. Except you missed my story.
Spice it up a little bit.
Yeah. The guy's passed away now.
How long was he in prison?
A couple years. It ruined his business too. Okay, so we were talking about to be a business, to write off business expense, you gotta be a real business. Can't be a charity. Can't be a hobby. And it's gotta be reasonable. If you have somebody performing services for you, you have to document it. And the story I was telling is I had a dentist. He had a picture up of when he was Dentist of the Year in Hawaii. So, right sometime after I'd just had been there maybe a year, he actually went to prison. He put down that his wife and his son were working for him. His wife never came into the office. His son actually lived in California, never came into the office either. And he wrote off big salaries for them. And
Did you pay payroll taxes on that?
I don't know. I didn't want to ask him. I didn't want to get involved. I didn't want him to ask me to, oh, could you be my accountant? No. But he went to prison because he made up stuff. And he was a prominent dentist. It ruined his whole business.
He just got greedy.
He got greedy, yeah. Or somebody told him, oh yeah, you can just put
Do that.
yeah. Not so much. Okay, so for services, you gotta have proof. That's why this whole story got started. That's on the front. We're starting on page 59. Then we go over to page 60. Expenses must have been paid or incurred to write them off. Okay, so we're gonna, later on, we're gonna have to, you gotta know the difference between cash and accrual accounting. So one of the first expenses you gotta eat for employees, they gotta be for individuals, for services for a company. The company controls when and how they work. You guys is everybody familiar with the difference between being an employee versus independent contractor and how that, I think that's in this chapter later on. But you're gonna get a question or two about that. Okay? Deductible test, they gotta be ordinary, necessary, reasonable. So if you have a guy that's supposed to be your night watchman and you give him a $100,000 a year salary, that's probably not gonna work very well, especially if he's a relative. You probably wouldn't be giving strangers that kind of a salary unless this was real important. Okay, cash payments, loans, or advances made to employees may be deducted if it is doubtful that the employee will repay the loan. But you can't write it off. Okay, starting off, a loan is not wages, it's a loan. If the guy quits or you fire him or something like that and you're not gonna ever get paid, then you can write it off as wages. Everybody see the difference? That's the same, sort of the same thing. It's not applied here, but You know, like lots of people have 401ks, they borrow against their 401k, and for whatever reason, they quit their job, move on. Well, then that money they borrow becomes taxable. Now it's a distribution for that 401k on a 1099-R, and they come into your office going, what do you mean?
Wait, it becomes taxable because they didn't pay it back or they
Yes,
quit?
both. Okay. As long as you're working there, they've actually, part of it that I didn't mention was they are taking the money out of your pay to pay it back over a 5-year period. When you're not working there anymore, they can't get that money back, so it's now a distribution from your 401k. Which is the same thing as if you loan somebody money that works for you and you're taking it out every month to pay you back, and then they quit. Well, I don't want to pay that money back.
So to remedy that, you pay it back, transfer it, and get a loan again. Right?
Yeah, that'll work.
Because
Don't borrow the money in the first place would be my preferred option. But sometimes that just doesn't work. Life doesn't always work the way you want it to. Okay. Vacation pay. Okay. Vacation pay is income to the employee whether or not the employee chooses to go on the vacation. Okay, but if you don't give them the money till the end of the year, okay, it's not, even on an accrual basis taxpayer, it's not income. It's not payroll until it's actually paid. Vacation pay is a little different.
Like a bonus?
No, vacation pay. Okay, I work for you, you work for me all year long, and besides your regular pay, you get an extra $3,000 vacation pay. But I didn't pay you that by the end of the year. I can't write it off as that I did pay you, even if I pay you within the next 2.5 months. For unpaid salaries, on the other hand, I work for you, I work for you. You, on an accrual basis, you don't pay me till a month later. You can still write that money off that I worked for in December in that year, if you're on an accrual basis, right? You can do that with your salary as long as you get paid within the first 2.5 months. But you can't do it with vacation pay until you actually give them the money. It's all written right here, just read it. I should be doing that anyway. Okay, non-cash payments. Gifts of nominal value, what? No worries. It's a non-wage expense. So I give you free use of the computer for you to type out letters to your parents or kids or whatever. There is a little bitty value, but it's de minimis. I let you take home some pencils and paper clips. That's de minimis. Occasionally, I buy pizza for all the employees late at night to work late because it's right close to April 15th. That probably wouldn't have to include that in your wages. Okay. Okay, cafeteria plans. Cafeteria plans are usually not taxable unless what? Unless you choose cash. A cafeteria plans, you got several choices. One of them might be cash. So I could take health. In Hawaii, you gotta have health insurance. But I was living in Texas, and I could choose to have health insurance, a life insurance policy, or I could take the cash. I choose the health insurance. That wouldn't be taxable to me. I don't have to count it as wages. But if I chose cash, that it would be wages. That's always, if they give you cash, it's wages. And it's not only cash. It's not on this page, but it'll be on here real soon. They're going to show you that it's cash. What do you call those little cards you get from all the different stores?
Gift cards.
Gift cards. That's the same, or any other kind of credit card situation. anything that's a cash substitute, that counts as cash. And so you'd have to count it as income to the employee. Okay, here's a bunch of stuff. When an employee makes payments or reimbursements to an employee's qualified education, that is not taxable to the employee, but the company gets to write it off, and it looks like the limit's $5,250. I think it's been there for a long time. The courses don't have to be job related; they can be graduate, undergraduate. The reason I'm bringing this up, this is I'm just trying to bring up what's a lot of times these are the questions they're going to have that. Daycare, they can give you up to $5,000 for 2 kids, $2,500 for 1 kid. What happens if you sign up for daycare from your company and you get them to give you $5,000 for your 2 kids? But you forgot to tell them that, oh, my mother's taking care of the kids this year. Oh, I got that $5,000, but I didn't really pay it. What happens? That $5,000 becomes income. And that would be one that they might bring out. Group life insurance, they can give up to $50,000 of coverage and you don't have to pay anything. Now, the company gets to deduct all this no matter what. But the difference is they don't have to put it into the employee's wages. Fringe benefits, here's a whole list of them. Standby flights to stewardesses. Although I know a stewardess that is getting flights, and they're now making her pay tax on that. I don't know what the situation is. She's a retired stewardess, but she gets flights, and in her case it's to Samoa, that's where her family's from. But now she's having to pay tax on that. Standby flights aren't the same, you know. Okay. What de minimis fringe benefits, that means little bitty things that they give you. Qualified employee discounts. You work in a grocery store and they give everybody that works here 10% off, no problem. Transportation fringe, you need to know this one. You get either $260 a month for the computer or transit pass, or $260 per month for parking.
So the company parking, the building parking is $300. The company, so $260 is not on the W-2, and $40 is?
Yes.
If they give you the whole day?
Yes, that's right.
Okay.
That's what it's supposed to be. They could get, that one's kind of a close one. But that's what they're supposed to do. What else? Athletic facilities that are on the premises, they can't give you a 24-hour fitness membership unless you work for 24-hour fitness. But if they have like a health club on the premises just for the employees, that's a fringe benefit. It doesn't cost you anything. If they have qualified adoption expenses, you might want to remember the number 13,810. I don't know if they would be that tricky, but I know they've done that before. Occasional tickets to sporting events, I probably wouldn't include 2 Super Bowl tickets with a flight first class. Nah, it wouldn't. Okay. Okay, if you have an employer car for personal, they provide you with a company car, they have to add that to your wages. They can't give you child employed by parents. Yeah, I did this. If they're under 18, so here we go. I had 3 kids under the age of 18. They actually came out, they cleaned my flower bed, they emptied the trash, they did filing, they did stuff. They only did it maybe 1 day a week. But they got, you know, they got to do some work, they got money for it, and I got them to at least do something as opposed to playing video games. Okay, so what happens? I didn't have to take money out for Social Security and Medicare. And I didn't take any money out for withholding because they weren't going to have enough. So they didn't have to do any of that. Okay? What is the year? You need to know the year. 18, they may ask. Okay? If the services or work other than a trade or a business, such as domestic work, the parent's private home, they're not subject to Social Security or Medicare until the child gets to be 21. That's for your child. How one spouse employed by another, they are subject to all those things except for feudal. And the rest of this, on this basically just read this. There's nothing in here. Statutory employees, everybody know what I'm talking about? That statutory employee is a life insurance agent or somebody that goes around in a truck delivering stuff like Cokes or beers or whatever. Anything except for what? Milk. They asked that. I don't know why, but remember, milk for some reason is exempt. It's been that way forever, and I don't know why. Actually, I don't think anybody delivers milk much anymore, do they? When I was a little kid, we had a milkman deliver. I remember all that, but that was 65 years ago.
18 years ago.
What's 65, 70 years anyway? Okay, so statutory, what do they do? On a statutory employee, life insurance salesman, those guys that go around. So they get a W-2, no withholding, but the Social Security and Medicare is taken out. The difference is they get to put that W-2 carries, their income carries over to a Schedule C, and they get to deduct all their expenses. They're not subject to Social Security and Medicare or self-employment tax because they already had it taken out. And you know that on like box 13, there's a little thing for statutory employee that has to be a little X in there. That's not on here, but that's all right. Documentation of compensation deductions. So what? You guys got to give them a W-2. Is there? When do you have to give it by? January 31st? When do you have to have yours in now? I believe it's January 31st. It used to be February 28th. Now they brought it up. Why? Because of the Russians. I'm not kidding. Okay, the Russians and all the other people that were using identity theft, filing tax returns, as soon as electronic filing opened, now they've stopped electronic filing. It almost, wait until almost the end of January. You have to have it in, so they don't get it processed until 2 or 3 weeks into February. Nobody's getting money, and they have a computer that checks all the W-2s against the people that are filing and turning in W-2s. You guys, did everybody know that?
Not about the Russians, but I know about the earned income credit, and so
It's in the third week, and but it's the same premise. They want to have time to match the kids against the Social Security records. You know, now Social Security has, so it's got the person's name, it's who their parents are, who their grandparents are, so they can actually match a lot of niece and nephews, and when they don't match, and they can send out a letter going, hi, could you send us your copies of your birth certificates to show this is really your grandchild or this is your niece or nephew? I don't know about you, but in my company, we have started like having to hold the people down, tie them up, and grill them to make sure that they're really their niece and nephew. It's gotten scary.
Do you guys ask for birth certificates when you're
We try, but there's no rule that says you have to get them. Okay, but if they were starting to more and more go, do you have your Social Security card, birth certificates, and proof that the child actually lives with you?
School records.
Huh?
The
School records. Do they have all this stuff? Mostly not. Can you make them get it? Yeah, you can, but you're a jerk if you're gonna make these people that come 30 miles all the way from Waianae to come in here. Well, you gotta go home and get your school records, and that's gonna take you a week. I mean, yes, I was at several months ago when I went to Vegas, I was in a due diligence classroom. It was about earned income. That's what this lady said. And I said, well, what happens if somebody comes into you? They're English is a second language. They're a yard person, and they don't really have any good receipts because that's the way the business runs. She goes, I just show them the door. I don't. I thought, well, you're a nice lady, but that's the way she is. I've known her before. She's spoken several times before at other things that I've been at. She's noted as follow the rules kind of person, and that's what she preaches. You have to have a birth certificate. You have to have Social Security card. You have to have proof of residency, or she won't do your tax return.
Wow.
But there is no rule that says that.
Right.
It says what? If you don't have this stuff, you need to ask further questions and document that you asked the questions and their answers. I asked, and they told me that this was their child, and their child lived with them, and they could get Social Security card, birth certificates, and proof of residency if needed. You now follow the rules, and you're safe. Because if you really add up all those little $530 penalties, what, $2,120, $2,120? That's a lot of money, especially if you're only maybe getting $200 a tax return. Okay, sorry to get carried away, guys. Let's get back on. Okay. If they didn't get their W-4, are you required to give them one? My answer is yes. If they say to you, I either lost it, don't have it, I give it to them. I've had people have hard times getting them before. But
And sometimes I don't understand it.
well, if they come to me and I can't do it anywhere else, I will call the owner and go, hi ma'am, so-and-so, I'm a tax preparer. And my client said, she asked you for a copy of the W-2, and he goes, well, I've already given it to her, I don't have to give it to her again. I go, yes you do. And when I hang up, I'm calling criminal investigation at the IRS, and I'm gonna give them your name and phone number, and I'll have somebody from there give you a call. Is that okay?
That's, you're calling the employer.
Huh?
Mhm.
That's my client. I actually had that happen once. It's called Woolworth. They used to be in here 20 years ago. These 4 little Filipino ladies that were all owed, not too bright. They came in, in this case they gave them wrong W-2s. They put allocated tips on these ladies, and they were not really waitresses. So, and they tried and tried to get the W-2s fixed, they wouldn't. So, I called, I actually gave the guy's number. I gave him the criminal investigation office at the IRS, the address. This is when it was at the federal building. They actually went down there, they went to the office while they were telling the person, the secretary, the head of criminal investigation for Hawaii came out of the office. He says, come with me, ladies. This was a great story. He took them into his office. He called the president of Woolworth, got the secretary on the line, goes, my name is so-and-so, I'm the head of criminal investigation in the state of Hawaii. I've got 4 of your former employees here. I'd like to speak with the president. The president got on the line. He told them, going, these ladies have been trying for months to get their W-2s corrected, and nobody will help them. They've been they had to call the mainland a lot of times because they closed down the Woolworths in Hawaii. That was part of it. And nobody would help them. Of course, the good part of it, their English skills weren't so good. Anyway, so the president goes, I'll get right on that and we'll get it fixed. And in a couple of weeks, the ladies came back towards the end of tax season and they got their refunds. I think that's a great story.
And the tip amount got deleted.
Yes, it was allocated tips. They had allocated tips to them, but they were the breakfast ladies helping, and they were allocating everybody, the nighttime people, breakfast people, off the total, which wasn't correct. Because people that do breakfast shifts don't make near as much money as people that do nighttime shifts. Okay. Anyway, that turned out good. W-4s, whatever they say in here doesn't apply. Does everybody know they're changing the W-4s up big time? And on the 22nd, they had a webinar the IRS did. I missed it. But in one more week, you'll be able to go online and get that webinar and look at it for free.
I think they have it up already.
Okay.
I can forward it to you. I think I have the webinar recording.
Yeah, because I looked at it a few days ago, couldn't find it, so I emailed the IRS person, and she says it's going to be up within 3 weeks. It's 2 weeks as of today. But okay.
Give it to me.
If you think you're going to have no income liability, you can fill out your W-4 and not have them take any taxes out.
Oh. This is called Understanding the 2020 W-4 and how to use it to calculate withholding. It's now available on demand.
Okay, great.
Okay, I'll forward it to you, and if you can forward it to everybody else.
All right. Okay, does everybody Form 8300? It's the $10,000 form. If you give somebody, some employer, $10,000 either in a transaction or string of transactions, he has to report that to the IRS. He's supposed to get your, thought it was a cow for a second.
What?
Okay, so he's got to report that. The form's called 8300. Know the name, that's what, does everybody know that you have to report 10,000 more in cash? Okay. Employee tax deposits. So if you've got employees, you've got to make tax deposits. Depending on the amount of money, you either have to make them monthly. If you have to make them monthly, you got to make them by the 15th of the following month. So if all the wages I took in by the end of January, I got to put the money in by the 15th of February. If I can't remember, but I am one. If you have too big of a payroll, you have to do semi-weekly. That means if you pay the people, I don't know, let's see, Saturday, Sunday, Monday, Tuesday, then you got to get the money in by Friday. And if you do Wednesday, Thursday, Friday, then you got to have it in by the following Wednesday. I don't know if they'll be that picky, but that would be an easy one if they do. Oh. The look-back period starts on June 30th. So for 12 months. And over that 12 months, you have more than $50,000 of withholding, including Social Security, Medicare, then you've got to do it semi-weekly. If it's less than $50,000, then you can do it once a month. I don't know if it's in here, but there's also a really high period that you could do for employee has accumulated 100 or more of undisputed employee taxes, then he must put the money in the next day. It's $100,000. So if you have your pay period, your employment taxes is 100 grand, you gotta put it in the next day. Okay, you always get at least 3 weekdays, so if one of your 3 weekdays is a holiday, you get an extra day. And my software, QuickBooks, gives me a bunch of nuisance email kind of things telling me that. I don't care.
Use QuickBooks Online or?
No, I hate QuickBooks Online. Sorry, it's one of my pet peeves. QuickBooks Desktop. And I've been using it for close to 30 years. It's changed. It was Quicken in the old days. And then there was a separate program for employees, and it's evolved a lot of times. I think they intentionally do this so they can get more money out of you. Okay, so if you deposit all this money, how do you do it? You know, up until about 5 years ago, you could take a little coupon and go down to the bank and deposit. Now, you have to do it through EFTPS. You can either call them on the phone or do it through your computer. I personally do it through my computer, and it works really well. Cost of goods sold. Does everybody here pretty much know cost of goods sold? You're gonna get asked a question or two about it. The thing they don't have in here, they got raw materials, labor, materials and supplies, overhead, but they don't have something called purchase goods. What happens instead of manufacturing something, you just buy bicycles wholesale and then turn around and sell them retail. Then you start with beginning inventory, purchase goods, subtract inventory, and that would give you your cost of goods sold. But anyway, this is the same it's been forever. Interest expense. You can write off interest if it was used to finance a business-related property, prepayment penalty on a loan, unstated interest in the extent of something you sell. I sell, let's say, I sell a property on the installment basis, and I sell it for 100 grand. Well, I'm supposed to sell it for 100 grand plus interest. If I don't, then they have what's stated interest, which is the federal rate, just say 4%, and I have to count 4% of that money I get as interest. Interest income is ordinary income, where the other would be capital gains. You understand? Okay, what are non-deductible interest points, loan origination fees, capital interest? I buy a machine and it has interest on the machine. The machine costs 100 grand, interest of 2 grand. I would add that interest to the machine. It would be 102 grand, and then I'd depreciate it. Okay. Refinancing, just go ahead. You guys just can read this. All I can do, I can't tell you that much. Rent expense, prepaid rent and lease payments are deductible only for the amounts that apply to the use of rent property during. So this is property you're paying rent on. You're renting an office building, you're renting any kind of building. You pay rent. So you pay $2,000 a month for all 12 months, that's $24,000. So you start renting the place on October 1st, and you pay them the whole year's rent on October the 1st. you can only write off the 3 months that apply to this year. Everybody got that? Okay. If you have a deposit that goes along with it, you don't write the deposit off at all. It's not a rent expense, it's a deposit. And in theory, you get it back at the end of the rent. If you have a deposit, first month, last month's rent, you would write off the first 2 months' rent. I'm not sure about that.
Doesn't it depend on the lease? Like
Yeah.
how long of a lease, if it's within the next 12 months, then you could, but if it's
No,
shorter
you
than
couldn't.
that, then you wouldn't, right?
No, but on the other hand, if it was the other way around, you were the person getting the income,
Uh-huh.
you would write off first and last month's rent when you got it. So the guy that's renting the place doesn't pay by the same rules as the guy getting the money. If I get money for rent, I'm the guy collecting the rent, I write it off when I get it. So they gave me a year's rent in advance and a deposit. The deposit is just a deposit. It's a deposit. It goes on your balance sheet. But the $24,000 they gave me would go in income this year. But for the guy that paid it, he couldn't do that. He could only take the proportion for this year. Everybody pretty much understand that?
The prepaid rent, it's.
Prepaid rent, you can only write off the rent for that year. The cost of acquiring a lease are capitalized and amortized over the life of the lease. So, I paid $1,200 to buy a lease. And I did this, and it's a 12-month lease. So, I did that on October 1st. So I would take, and I pay $2,000 a month. So I'd get $6,000 of rent and a portion of this. This is a 1-year lease. I paid $1,200, so that's $100 a month. So $300 I could write off that year, and the other $900 I'd have to wait and write off the next year with the rest of the lease. Does that kind of make sense to everybody? They have questions like that. But it's probably going to be a 5-year instead of just a 1-year. I did it so that my math would make a mistake. Okay, taxes paid or accrued in a trade or business are deductible. Okay. Sales tax, deductible. Occupational license, deductible. Property tax, deductible. Income tax, Okay, your federal income tax generally are not deductible. Your state are not a business expenses of a sole proprietorship. Where do they go? They go on your Schedule A. Now they're limited to $10,000. Individual tax, okay. Taxpayers can either deduct their individual taxes, or they can take the sales tax, or they can, the actual sales tax. Has anybody ever had anybody do that? Come in with every receipt for a year? I've had it once or twice. And I tell them to go back and add them up themselves.
For every purchase they make.
Every now and then, if somebody bought something like a brand new car and paid a high amount of sales tax, it would be better for them. So if you paid 4% for a $50,000 car, that's $2,000 in sales tax. 4.5 would be half a percent.
that, you consider like when they buy a car,
Yes,
right?
that is
So-
a sales tax.
It is, okay.
It's-
Yeah, I don't know, like, I always emphasize, there's a difference between sales tax and GE tax to my clients. And so when I read the IRS instructions, like, I don't know if that, like,
It's the
if
same.
Hawaii would be
Yeah.
considered, like,
They count it.
they count it, okay, that's good.
Is it only the car?
No, I just use that as, they could buy anything, furniture, car, there's no sales tax on houses. Airplane, we don't have a lot of our clients buying airplanes. But you could buy a boat,
Like everyday groceries?
everyday yeah, that's what this one lady had, brought a big box with every one of her receipts. And she wanted to write those off.
So you're saying the GE tax that's added is sales tax which the business can deduct?
Yes, they,
Really?
not the, well,
What?
a business writes off the whole amount of the, I buy $100
Right.
calculator
Right.
and I pay 4.712. So I pay $104.71.
Right.
I would write off the whole amount, $104.71 as a business expense. But for a person, they bought for just their own personal calculator, they don't get to write that off. But what they can either choose their state taxes they pay or their sales tax. And you either have, I have it up on the wall. We used to have it for all the desks here. I have a little thing that comes out of the IRS. You have this amount of income and this number of dependents. You go across and that's the amount of, you can use that as your sales tax, or you can add up every receipt. Nobody, but just one or two people that, this, we're talking forever, has done this. That's a lot,
You can do a spreadsheet and do it daily.
huh? I can't. But that they can do that legally now, but I made her go back to what I can remember and go, you add them up. I'm gonna charge you $100 an hour in advance.
Right.
Okay. What are the kind of in taxes? Well, if you're self-employed, you get to write off half of your self-employment tax, okay, as an adjustment. If you got federal excise taxes are different than Hawaii excise taxes. Federal excise taxes, gasoline tax, and others, but only in certain people. Let me see, what is it? What do you call it for the big trucks that they get to write off that gasoline?
Oh, that diesel tax.
Diesel tax, you get to write off that, and there's a special form. And first thing I do when they go, they're gonna do that, go, let me see your last year's, so I look at last year's tax return to find the number of the form. So I can remember, because I can't remember how they do it a couple times a year. And if we did theirs last year, then it'll already be there. Okay. Then all you did was just read most of that other stuff. I didn't even hardly highlight anything. Real estate taxes. Property tax. So if you're just a personal home, you'd write it off on Schedule A. But if it was a rental property, it would go on Schedule E. If it was a business property, it would go on Schedule C. If it was farm, it would go on Schedule F. And that's about it that I can think of. One other, I don't know how it was gonna work now. He's gone. I had a gentleman that had 10 or 15 houses that he would sell, but he would end up getting them back all the time. And in between, he would have the house and it would be investment property. So he had to pay, he wasn't running a business, he was just investing in houses. Okay? He was not renting them, he was selling them. The rentals, no problem, he did have ski rentals. but he would sell them. Then the people, he would do it no money down, charge you higher interest, and you had to pay him at least a certain amount every month, okay? And it was less than if you had gone to a bank. But he kept title, or he kept something, no, he didn't keep title. What did he keep? He had a way where it was easy for him to get the house back if you defaulted. But, okay, so he has a house, he gets the house back. While he has that house back, that's an investment property. Where does he put the expenses for an investment property? Up until this year, he would put those expenses on his Schedule A, investment expenses. He would also have sometimes a mortgage. Then he would have investment interest up till at least his income. But he had, all of his income was interest income because it was interest from his mortgages. So he had a lot of interest income, so he always could write off his interest expense. He was an interesting character when he moved to Oregon.
So what happens now, because you can't deduct it on the Schedule A?
I don't know, because he wasn't here this year.
So he's only gonna be able to write off the, I mean, he has to include.
Well,
the
he got a
interest
lot of
income.
other writes off now.
Oh.
If you don't get to write off your investment expense, you don't get to write off your investment expense. And I think that's what's happened.
Investment that he can't write off your investment expense? Like a rental property on Schedule E?
Yeah, that's not an investment, that's a rental property.
Oh, okay.
See, I
All of
think
his
so.
rental property, no
That's
problem.
interesting.
All the property that he sold, he's getting just mortgage interest. It's all on an installment sale,
Oh, wow.
okay? It's the property that he foreclosed on and gets back. And then before he sells it again, it's an investment property waiting to get sold. And so there's no place now for his investment expense. He hated Trump anyway, so it didn't matter. He just hates him more. Okay.
He has to know over his taxes.
Huh?
He hasn't yet.
This battle's not even close to over. It's gonna probably go to the Supreme Court, and we'll see if the Supreme Court is really independent or did he stack the deck. If they go, the president doesn't have to obey the law. The problem's gonna be, there's gonna be a turning of the worm, and when the other side gets control, they're gonna scream bloody murder, but they've already passed the laws. Okay. Okay, what happens if you have penalties? Penalties are not deductible, generally speaking.
Wait, what is penalty taxes? Like not paying taxes on penalties.
Any penalty on any taxes, yeah, not paying your, I owe my GE tax. I don't pay my GE tax. They hit me with a giant penalty.
That's not deductible?
No.
Oh, even IRS penalties?
Huh?
Yeah. So I was, when we do books, like say somebody got a speeding ticket, any kind of moving violations, I classify them as penalties. Are those deductible?
No.
No.
They're considered penalties, right? I mean, it doesn't
Yeah.
have to necessarily.
Okay,
relate to
you're in the
taxes.
business, I've heard this argument too.
Okay.
You're in the business of being a truck driver.
Yeah.
There's no parking spots for your delivery. You go up there and double park, go take your stuff inside. While you're in there, you get a ticket. Or you double park in either way, you get a ticket. And go, this is my business, I wanna be able to write that. No, you can't.
Right, okay.
No.
That's against the law. How come penalty is not?
It's against the law for you to not pay your GE tax. It's against the law to not pay the IRS or the state of Hawaii. And okay, the law goes like this. you can get an extension to file your taxes. You get an extension. That is not an extension to pay your taxes. Your taxes are due April 15th or April 20th. And the state has a killer 20% penalty for not paying. The IRS has a 0.5% penalty for not paying, and it's a 5% per month penalty. Both of those, okay, for not filing. So if you file on time, you get 6 months, and you don't owe them much. The state doesn't play that way. We've already had several people lately that they're whining.
I thought it was 5% per month, up to 5 months, so max is 25%.
No, that's for not filing.
Oh.
Not paying is a 0.5% a month. So, and it's subtracted from the 5%. So, if I filed an extension and I go all the way to October 14th and file my tax return and pay it at that time, I have a 0.5%, let's just say, times 6 months is 3%. So I only pay 3% plus the interest. So if I owed them $1,000, that would be $30. If I owed them $5,000, that'd be $150. That's way better than $1,500. The state doesn't have that. We've been explaining, all these people going, but I have an extension.
Right, I know.
You're familiar with this?
Yes.
You guys, okay. So, now do you understand what penalties? Any kind of, oh, wait a minute, I don't know, I didn't see it, but here's what is not a penalty. If I have a penalty, I've got a contract to get it done by April 1st, a business contract. And if I don't get it done by April 1st, I have to pay a penalty. That's not a penalty like this. That is a non-performance clause, and it is deductible.
What would you classify that expense as?
Non-performance clause, non-performance fee. I'd say the word fee, just leave it. And then if they made me prove it, then I'd go back and show them. But we'd still win. Okay, so let's go to the next chapter. We actually are doing good. These are as I told you, these first 4 chapters are the easiest. Then the next 2 are not going to be very hard. It's going to be basis, which we've already gone over. And then after that, depreciation, which you guys should already know by the back of your hand. The only thing is you got to be able to know how to do it without the computer doing it, the software program doing it for you.
Yes.
But they're not going to have really hard ones. And they don't usually use half of your convention, so you don't have to figure that out.
Good.
Well, it could be straight line, or it might not be. It wouldn't be past the 2nd year anyway. You know, when it ever gets to where straight line is higher than makers, you get to switch. You know, in about the 3rd or 4th year on a 5-year property, it'll be in the chapter. I guess it was you I was talking to about the food and beverage portion is still deductible. So if you took your employees out for a meal and you gave them potato chips and half a case of beer, that would be a meal.
That's deductible? Heck yeah.
For construction workers, that's what they prefer. And I actually have a guy that does this. Actually, I don't. My son does. And he has a client that he has a whole lot of this, where he's got bar kind of things where, no, I'm taking my employees out. Anybody else wanna hit the restroom first? Yeah, go ahead. We're ahead. We're gonna get out of here early tonight. I'm trying to make this as easy because it's gonna get a little more difficult when we get to what's the basis of an S corporation, what's the basis of a partnership. Then that's the basis on a yearly basis. Then what's the basis when you sell your partnership?
Oh.
They're not gonna give you really hard ones.
Isn't our last day next
Are
Tuesday?
they, huh?
Our last day here is next Tuesday?
Huh? Wrong, paleface.
When's our last day here?
Probably December.
Oh, good.
Probably, how about Christmas Eve?
Oh, wow.
Just
It is
kidding.
Christmas Eve.
Huh? We're not coming in here on Christmas. We're gonna be done by then.
New Year's Eve.
Or,
Keep
where's
extending
Lynn?
it.
I left and had to go do umpiring, and I wasn't here, and when I got back, all the beer was gone.
Oh.
My sons drank it all.
They figured.
That was that Halloween?
Mhm.
Yeah. All right, so now we got some more deductions. All these are business deductions. So meals. So everybody knows that before you had meals and entertainment. They did away with the entertainment. Now it's just the meals and the beverages and even, yeah, just meals and beverages. So if you take somebody out drinking at a bar, that would count. You take them out for a meal. So what are they gonna say over here? There's two kinds, directly related and associated. You need to know this. Directly related, you gotta talk about the business while you're there. Associated, you gotta talk it right before or right after. So you can't send somebody out and go, here, here's your $20. You go out to Zippy's and write that off. You gotta go with them.
That's not like a promotion.
Or you give them a gift certificate
Yeah.
and write it off as a gift.
That, yeah, you could probably get away with that if you kept it under $25. Okay, but that would not be a meal. So, and remember, we're gonna go meals, what? Are gonna be 50%. Unless your Department of Transportation, it's 80%. So if you're a long haul trucker, you're an airline stewardess, an airline pilot, somebody like that.
So anything related to transportation.
Yeah, I believe if you're a merchant marine, okay, you can't be if you're on the boat, you can't take off per diem. But if you get to port and you're 3 days in Singapore, you'd get the per diem for Singapore, which is probably about $150 a day for food. And that's probably gonna be a liquid food. Okay, so everybody knows associated direct related expenses. So, and you can only write off 50%. What does that include? Tax, tip, parking fees. Okay, but there is no associated entertainment. So if you took them to a UH football game, you could write off the hot dogs you bought them, the pizza, the beer. Do they sell beer at UH football games? Okay. But you couldn't write off the tickets to the football game anymore.
Can you tell me again, which ones can write off 80%? Truck drivers?
Let's see, it's on here somewhere.
Truck drivers.
It's long haul truck drivers, not just a local guy. Okay, Department of Transportation. If you go to page 88, number 2, 2/3 of the way down, for individual subject Department of Transportation, hours of service
Oh,
rules.
yeah, okay.
So this would be somebody that's gotta go away from home
Yeah.
and they're in the transportation field. Truckers, airline stewardess, airline pilots, merchant marines. I can't think of anybody else.
We're thinking about businesses, right?
Uh-huh.
How-
Yeah.
How are stewardess business, how is stewardess deducted?
The stewardess and the airline pilot and the merchant marine and the truck drivers have just got screwed. Up until this year, they could write all of this off. Now, there's no more employee business expenses, so they can write it off on the state, but they can't write it off on the federal. If you're a long-haul trucker and you're self-employed, you still get the 80%.
It's right up on the seat and not federal. That's.
Yes. And I believe that every stewardess and airline pilot agree with you.
Yeah.
Why would they do that?
They did away with all employee business expenses
That's what's starting 2019. right?
18
Oh, 18.
this last year. Okay, on page 87, there's the general rule definitions, tests to be made. That just, go ahead. Somewhere I haven't gotten there, but let's see. IRS is denied deductions for any meal expense over 75 if you did not provide substantiating expenses. You gotta have receipts. You gotta say who you took out to dinner, what was the business purpose. If you took out the owner of Toys R Us and you're a toy salesman, that's pretty self-explanatory. But if you took out your significant other, that may not be explanatory. How is taking out your friend on their birthday a business deal? Okay, well, you gotta have, if it's over $75, you gotta have a receipt and explain it. Okay, an exclusion for employee income for employees, meals furnished on a business premises of the employer apply if they're furnished to the employees for the convenience of the employer. That's at 50%. Here's another one. They used to be at 100%. That I don't like, because I've been providing meals. You get an employees that are rushed and they don't have time to go, go out to go get something to eat. So we go buy something, bring it in there, and then when they get a chance to get something to eat, I don't know if you guys get that rushed, but in February, we got sometimes a line out the door. Because we're cheap.
And how many tax preparers do you have?
23.
Wow.
Not in here. I have 4 offices,
Oh, okay.
and this is one of the smallest,
Oh.
but it does almost the most tax returns.
So location.
We put 1, 2, 3, 4, 5 desks running. And a receptionist or 2 making copies.
So I have a question. So if the owner say buy Starbucks every day, and she wants to deduct it, $5
Huh?
for as a meal deduction.
Who?
Owner of a company.
Are they, okay, first, you as an owner can't go write off your meals. You can write off your meals if there's a business purpose. You took your business person that you have a business relation, and you both go to Starbucks, then you could write off both of your cups of coffee
And discuss business. Okay.
and discuss business. Or you can discuss business as you're walking from the car and standing in line at Starbucks, and that would still probably count.
And not meals for yourself.
Not meals for just
owners.
yourself, ever. In fact, somebody just recently emailed me, another preparer from another island, and says, hi, I've got a client that she has her personal meals and her business meals, do I have to separate those? And I was going, you should be in this class. And the answer is, you don't get to write off your personal meals as a business expense. But it'd be a long commute. Okay. It used to be the meals for in the office were 100%, now they're 50%. What's the exception? You have a party. You have a Christmas party for your employees, or you have an end of tax season employee party for your employees. You can write off 100% of that.
Question.
Yes.
Like say, is it only for the meal portion? Like say you have entertainment, right? Like singers that come to this
Nope.
Christmas party, that's
No
still not
entertainment.
deductible.
Huh?
Even though it's employee.
That's entertainment. Entertainment is no longer,
Deductible.
yeah.
So, yeah, because somebody had asked me, what if they have, those rope courses for companies?
No,
It's not deductible.
none of it is. They gotta be eating or drinking.
So is that as of 2018 or 19?
Yes, brand new. This last year was the first year.
18.
Yes, we are studying this course based on 18,
Okay.
but it's still gonna be the same rule for 19. Okay, what's the rule? Meals and drinks. That's it, no entertainment. No, the old meals and entertainment is no longer good. Go back and talk to them, go, that was really a meal, that wasn't entertainment. Because I've had people do that, go, meals and entertainment, no, that was meals, right?
Right?
And explain the rule to them. And okay, travel expenses, this is they're gonna ask you about. Okay, so travel, if it's all business, you get to write off travel. The meals are still at 50%, right? Okay, no deduction is allowed. Primary purpose of it is personal. You go over to California, you just happen to be going to where your mother lives, and while you're there, you go by a convention for the day, but you stay a week or 2 weeks. That's not a business trip. That's a trip to see your mother that you just can. So then you would get to write off just the portion that was business. If you rented a car to go to, your mother lives in Los Angeles and you rent a car to drive to Vegas for a convention, spend the night, stay in a hotel room, all of that would be a write-off as a business. But the flying over there to see your mom, staying at your mom's, the meals, you couldn't write that off as per diem.
I like them to eat.
Huh? E, travel as a form of education. I've had that a couple of times. Okay, so you get somebody that goes, yes, I'm going to, it was Europe, it was actually Spain and somewhere, but she was going, I'm going with my friend and we're going to write a book. And that's not a write-off. Travel for attending investment meetings, those are not write-off. Again, you go to Vegas for 2 days for an investment meeting to do whatever, it's not a write-off. On the other hand, you go to Vegas as part of your trading for Amway. Believe it or not, you can probably get away with that one. As long as you're an Amway person to begin with, I'd say. Okay, commuting between home and work. What is that? Never do you get to write the miles off between home and work. Okay, if you have no regular place of business because of the nature of the work, you probably can't write that off. If on the other hand, you have an office and home, you have no other place of work, you do your bookkeeping, your accounting, your management from your office and home. And let's just say your office and home was a table this size where you had your computer, your phone, your filing cabinet, and a bunch of paper stacked up. It's against the wall. It's no longer than 6 foot times 5 foot, 30 square feet. You can take that 30 square feet, and that's an office and home. From that office and home, you can have your office, you drive to all your places of work. Now you get mileage legally, as long as you can document those miles. Is that all? Does everybody kind of already knew that? I hope. We'll get to office and home quickly. Foreign travel. I don't know if they'll ask you, but the mileage for 18 is 54.5 cents a mile. You probably already know that, but if you don't, you need to.
Why did they add an extra digit? 54.5.
What do you mean?
For 54.5 per mile. Like
54.5 cents is what that means.
I thought they rounded up.
They put a dollar sign.
where's that?
We're on page 88 under number 3 under auto expense.
Rounded up.
Okay, here's another one. I don't know if they'll ask, but let's say you have a business trip and it's, you have some personal in it, but it's more than half business. You would allocate 75% business, 25% personal. You'd get to write off 75% of your airline ticket, hotel room, rental car, other stuff. That's on domestic travel number 4 at the bottom of 88. Foreign travel, what do you got to do? It must be allocated between time spent on the trip and the business and the personal. If it's mostly business, you're probably going to make it. If it's mostly personal, not so much. Okay, so they've got a bunch of rules. The trip is considered entirely for business if you didn't have control over arranging the trip. Your boss told you to go to Afghanistan for a week to sell lots of toys for Christmas. Oh wait, they're not Christian. Wonder how that's going to work. Or you took the trip, it's not more for 1 week. Or the trip is less than 25% of the total time is away from home for personal reason. Okay, so less than 25% is less than personal reason, then you can write the whole thing off. No allocation is required. When a foreign trip is longer than 7 days, or 25 or more time away from the home is spent, a deduction for travel expenses will be denied to the extent that they are not allocable to the taxpayer's business. Your guess is as good as mine. Here's the example, 65% for business, 35% for not, so you get to write off 65% of the expenses. I don't know if they're going to do anything. Convention expense. So, meetings in connection with investment, finance, planning, or other income-producing property are not deductible. If you guys have all heard this, people have gone over to places for investment seminars. Those are not write-offs. Investment seminars are not write-offs. Okay, if you go to expenses for conventions on cruise ships, the deduction is limited to $2,000 for all cruises in the year. Okay, $2,000 a year. All ports of such cruise ships are located in the United States or U.S. possessions. The taxpayer established the convention is directly related to an activity conduct of his business. So if you went to a taxpayer's convention on a cruise ship, it would probably work. But if you went with a friend of yours and it was a banker or insurance salesman convention, you probably couldn't write it off. unless you were in the business of
What about
also
pe-
selling insurance.
People that are like entertainers on a cruise ship.
That's their job.
Oh, but that's their job.
They don't pay to go on the cruise ship. They're an entertainer. They give them a free place to stay, pay for their food, and give them money. They got a better deal. Except they gotta put up with a bunch of crazy people on cruise ships.
And they get to travel.
Yeah. I used to travel a lot. While I was being an umpire once upon a time, I would travel to the mainland, stay there for a week. Travel after a while is really boring. You know, especially you go work all day, go stay in a hotel room. It's not that much fun. If you were there on somebody was paying for you to go run around Disneyland all day, that would be great. And they pay for it, but that's not the way it works. A cruise ship, yeah. And if you're probably a working person on the cruise ship, if you stay up all night entertaining, you gotta sleep all day. Of course, you probably do get to do some fun stuff. But then you gotta go do it with all the people bugging you from the cruise ship. I don't know.
Sorry, Hank, so, you know those, like Rosanna Field or those kind of people who put out conventions, are those deductible?
Who?
The people who sells things, like,
Amway,
Amway or,
Melaleuca.
yeah. So what if they have like a specific convention on the mainland,
And they're a Melaleuca salesman here in Hawaii,
part-time?
and they go to that convention,
Yeah.
that's a write-off.
But what is income, how come income producing
They are producing income.
expenses for convention with investment, financial planning, or other income producing properties are not
Income producing
deductible?
property, rental property, investment property.
So if you're a, I don't know, Edward Jones representative and you go to investment convention,
That's your business.
that's your business. So
Yeah, that would
that's-
be like an accountant going to, me, I went to Vegas, remember a couple of months ago? I went for 2 days.
So if it's not a direct
Is that 100%?
business.
Yeah. I flew on an airplane, got there at 1 in the morning, got up in the morning, went to class all day, went out for dinner that night, got up, went to class all day, jumped on the plane, flew back.
Oh my God.
That was
100%.
not a vacation.
So if it was not your business, that's not deductible.
If you went to an Edward Jones convention and you're not an Edward Jones salesman, you're there as an investor, that is not a deduction. You're an Edward Jones salesman and you go to a convention to sell all the other schmucks that came over here to do this, then that's your business.
Okay.
Everybody pretty much, okay. So the taxpayer establishes that the convention is directly related to an active conduct of their business. Okay, the taxpayer includes a certain specified information in the return. They don't have it in this book, but you gotta put a little thing saying, this is, and I think they might even need, I thought they had to have something from the convention itself. It says, we had classes 8 hours a day, 5 days in a row for this convention while you were on this cruise ship. So you weren't out there getting drunk, going surfing and skiing all the time. You were actually going for the convention.
Itinerary.
Yeah.
Program.
It doesn't say it here though. Oh wait, a taxpayer can show that his attendance at the convention benefit his or her trade or business. The fact that the convention agenda does not deal with his or her specific duties lends support to the travel being ordinary and necessary. Okay, then transportation, just all you guys can just read this next one. Reimbursed employee expenses. Does everybody know the difference between an accountable plan, non-accountable plan? Accountable plan, your company has a plan that we will reimburse you for certain kinds of expenses. okay? And then you give the receipts to your company, and they either had reimbursed you before, you give them back the difference, or they reimburse you. You give them $432 worth of receipts, they write you a separate check, not payroll, for $432. That's a accountable plan. On the other hand, they just give you the money and don't tell you to give them any receipts. That's a non-accountable plan, and they have to add that to your wages. And then just read what's on there. Per diem, mileage allowance up to the federal rate. Has you guys ever looked at per diem here in Hawaii versus what it's like on the mainland? We're like close to 120 to 100, no. Yeah, 120 to 140 or $50 a day with per diem and incidentals. They're $46 a day, maybe in the high area 64. Welcome to Hawaii. Of course, I just heard that the Royal Hawaiian Hotel, their rates are $800 to $1,000 a night now.
What?
Yeah. Well, I saw it because I went on this website, and one of the things you can bid on a room there, and the bidding started at $400. They says the price of this room is $800 something, and I go, well, that's ridiculous. Who would ever do? And my son goes, oh, that is the price. It's there between there and $1,000 a night.
Is it a suite?
It's a sweet deal for whoever, but not for me. I don't know.
Oh gosh, it really went up.
Okay.
Yeah.
So what is it that makes it non-accountable? You don't give the reimbursements. Now, somewhere on here, it's got to tell you the days and the times. Reimbursements. You got to submit it within, there's like 30 days, 60 days, and 90 days. I don't see it on here. Yeah, for the reimbursements. Dang, where is it? Okay, I don't see it. That doesn't mean anything. So go to page 92, insurance expenses. All of these kinds of insurance. What kind of taxpayer may not deduct the following? Loss of earnings except for certain overhead insurance expenses, self-insurance reserve funds, premiums on life insurance policy, cost of self-employed taxpayer eligibility for coverage under a plan, self-employed health insurance is not deductible on Schedule C. You guys all know that, right? It goes on adjustments on Schedule A. Yep. An IRA, a SEP is not, for the owner of a company, is not deductible on Schedule C. It goes where? Adjustments. Really, Form 1 under adjustments. I told you guys last time, I think they're getting ready to change the forms back to somewhere kind of like what they were before. Somewhere in between. Just enough to get, hey, it's job security. Think of it as, if you have a hard time figuring it out, just think of what these guys that they've only been in the United States a couple of years are doing. English is a second language, and they.
I just saw the form for the first time.
Yeah. Okay. Insurance. Okay, remember insurance has got the same rule. If you buy an insurance policy for a year, so you buy it on 6/30 and you pay $2,400 for it. So 6 months, So you get to write off 1,200 this year, and you'd write the other 1,200 next year. Then when you paid for the next 1,200, you'd write off half and half, half and half. Everybody good with that? Workman's comp, is it a business deduction? Yes, for your employees. Is it for the employee? Schedule C employee? No. Liability insurance? Yes. Life insurance covers officer employees. Taxpayer is not the beneficiary. The key word is taxpayer is not the beneficiary.
Taxpayer is not the beneficiary, then it's a write-off?
Yes. Okay, bad debts. We got business bad debts and non-business bad debts. Business bad debts are where they're gonna be written off on like the Schedule C, the S corp partnership or whatever. Non-business bad debts are written off where? They're short-term losses written off on Schedule D. And there's a bunch of rules to go over this. We'll go over them. They're gonna give you at least 1 or 2 questions about this. They always do. Okay, a bad debt deduction is allowed only for a bona fide debt. So if I loan my kid, or I give my kid one of my cards and say, you owe me $3,000 for it, that's not really a loan. That's me giving my kid $3,000 car and hoping I get paid. Okay? Or I loan my sister money to start a business. Unless I go through, put it all in a written contract, has specific way, she's gonna pay me so much a month for so long, and go through the whole thing, that's not gonna fly either. On the other hand, I have a business associate. One of the guys one of my clients in the accounting world, I make a bunch of money off this guy. He's short, so I loan him $2,000. I write up a contract, we do everything legally. That's a business debt. That's a legitimate business debt. I did it because of business reason. I want him to stay in business because I can bill him a bunch of money. Okay, that's no problem. So you can only okay, on the same token, I'm a cash basis taxpayer or I'm an accrual basis. I'm an accrual basis taxpayer. I write off $10,000 debt to this guy in 2017. In 2018, he goes bankrupt. I lose my $10,000. I've got a $10,000 bad debt. On the same token, I'm a cash basis taxpayer. He didn't pay me the $10,000. I didn't write it off. So when he stiffs me for the $10,000, I can't write it off. They ask that question every year. Has everybody got that? Go ahead.
I have a question. Say you're on a accrued basis, right, and the debt becomes uncollectible, like a client, you can't collect from a client.
You've already written it off as income.
Yeah, it's accrual, so we wrote it off. I mean, it was included as income, so we wanna record it as a bad debt. Whenever you do a bad debt, are you required to issue like a 1099-C to the customer? So they report it as
You
income?
should.
Okay. I was just thinking about
The
that
word
today.
requires, I'm not so sure
yeah.
about. But you probably are.
You could, right?
You could and should.
If you don't collect it, that's one way to make them pay, right? Like, punish them. Well, not punish them, but.
And then they just go screaming to their accountant, Oh, wait, you're their accountant too. Oh, I'm so. Okay, bad debts of corporations are always business bad debts. Partially worthless business debts may be deducted to the extent of partly worthless. That is on business bad debts. Partly worthless personal bad debts, non-business bad debts, I think, is not deductible. So you guys see that, and it's down here in under number 3C. So business bad debt, a partly worthless bad debt, you can write off the worthless part. If it's a non-business bad debt, you can't. A business bad debt is treated as an ordinary loss. Okay? A non-business bad debt is a short-term capital loss. Okay.
Sorry. so
If you have a bad debt written off in a previous year but recover in the current year, you report it as other income. You got to add it as income.
Sorry, so non-business bad debt is a capital loss? You can write it off as a capital loss?
Yeah, short-term capital loss. Up to $3,000 now, remember, per year. We'll get down there. Okay. If you sell a business but keep the receivable, these debts are business debts since they came from a trade or business. So, you have a Schedule C business, you sell out the business, but you kept the $5,000 that the people owed you for prior accounting services. And then when you collect those, if you're on a cash basis, that becomes income. If you have bad debts and you never collect them, if you're on a cash basis, no harm, no foul. If you were on an accrual basis and you already counted them as income, then now you get to take them as a bad debt. Business bad debt. Ordinary income. I had this happen. Number H, any guarantee made by an employee to protect or improve his job is closely related to his trade or business is deductible to the extent that it's written off. So I had a lady that she worked for a company. She had the money. She loaned them, this company, 50 grand.
You know, the company.
Oh.
It didn't work out so well.
No, I don't think so.
So she ended up losing it. We put it on the tax return. It got audited, but we've had all the documentation, showed it all to them, and they let it go.
Where did you put it? Sorry.
I think we put it as short-term bad debt, not as business, but as personal. But we had, they had a full contract. Everything was written out how it was supposed to be. It was all done up at least correctly before the lady gave them the money. The key concept is you get everything done correctly before you give them the money. They will act better if you have the money over here and say sign here. If you give them the money and you come back a few days later, could you sign this and this? Oh yeah, I'll be back in a minute. Okay. Investments are not treated as trade or business. They're just, So a shareholder loans to protect his or her investment in a corporation is not treated as a business loan. A partially worthless, non-business bad debt is not deductible. It has to be completely worthless. A wholly worthless, non-business bad debt is then treated as a short-term capital loss. That's what we've already gone over, right? Okay, the rest of this you can just read. There's not anything there. Worthless corporate securities are not considered bad debts. They're generally treated as a capital loss. Okay, I own $10,000 in stock in this corporation. It's not, and I gave them $10,000, they gave me stock. That's not a loan. I just lost $10,000 in stock. So I've got a either short or long-term capital loss. Everybody good? We've already said this, but taxpayers can only take a bad debt deduction only if the income was already included in, the amount of money was already included in income and gross income. So if you're cash basis, you never counted the money as income, you can't write it off. Accrual basis, you count it as income. Now the next year you find out they got stiffed, then you can write it off. Specific write-off method must generally be used for tax purposes. So you can't mix all your losses up. You gotta, I lost this money from doing this transaction. And you write that one off specifically. Non-accrual experience method. This only applies to certain people. The accounts receivable services the taxpayer performs if the taxpayer meets the 25 million annual gross receipt test. That's not going to be any of my clients. And I'll just let you read that. Business gifts. Does everybody, hopefully you know this. You can give one gift per year equal to $25 to any person. If it's a husband and wife, you can only give them one $25 gift. Everybody got that?
And that's
So,
to companies too,
huh?
right? Companies too, right? You can't give.
No, you could have 5 people or 25 people in the company and give 25 separate people in that company $25 each.
I thought it was per organization or per person or per couple.
It's per person, per couple.
But
but
and
not
per
per-
company, but not per per
The
company.
recipient, yeah.
No, well, you could be like General Motors. You know, you don't even know.
Okay, that's good.
And you could give somebody money and not even know they worked at General Motors. Okay.
Why did they make the amount so low?
It's been there for 40 years,
I mean,
and it's a political hot potato.
Right.
Nobody wants to go, we raise the amount of money you give to people as gifts, to business people as gifts.
Inflation.
Huh? Hey, I agree, you're preaching to the choir. So, if this is my example, you're a real estate salesman. You just sold a $1 million house, and you want to give a gift to the people that bought your $1 million house, and you're in a 6%, $60,000, and you give them a $25 cheese plate, they're gonna throw it at you and go, we'll never give a recommendation to you again. So, you might consider figuring out a way to give a promotion.
Oh.
You, to set to different people that have helped you get, I'm gonna give you a promotion of some sort to help you help me get other clients, not a gift.
Like a company logo bag with $1,000 or something.
You can't give them money.
No,
No.
$1,000 gift card.
Eh.
So that whole
Because
thing
gifts
is
are
deductible.
deductible.
Huh?
The whole promotion is deductible.
Promotions are deductible. You gotta watch out if it quacks like a duck.
It's duck.
How would it quack like a duck?
Okay, give us some examples.
Yeah, give
Real
us
life
some-
examples.
No.
Oh, come on.
That's too close to the edge.
Oh.
If you give a TV and you put your sticker logo company on it.
A TV.
Yeah. That's
I'm
a
not so
promotion.
sure about that.
Okay. So what can you get away with?
I don't know.
You're mighty quiet all of a sudden.
Yeah, that's That's kinda close to the edge.
Okay.
But you can't, they have to say, this is a promotion. This is not a gift. I'm doing promotions to my best clients. Best clients mean anybody that bought $1 million house. And I'm giving them something, not as a gift. So, what are the rules? Okay. Things that you can do, the gift, you gotta keep records. But so, you can have things that you give that don't count as a gift. You give somebody a $10 pen with your logo on it, that's not a gift, that doesn't apply. The wrapping around the gift does not apply. So, you give them a $10 cheese plate wrapped in $100 bills. Just kidding. Okay, so we're coming down here to the end. Employee Achievement Awards. You can't give them cash. You can't give them, okay? You can give on an unqualified, what's the word? Unqualified plan, you can give $400. You can give $1,600 total to a qualified plan. And it would be the qualified and unqualified plans together. So, you could give $1,600 to a qualified plan to a guy. Or, you could have $600 non-qualified plan and $1,000 qualified plan. You could only give $1,400. You can't give more than $400 for a non-qualified plan. You still gave $1,600, but you could only take $1,400 here. Whereas since this was all qualified, you can take the whole $1,600. Qualified, non-qualified. Non-qualified, that's, by the way, that's one of the questions they always do, one like that.
Sorry, what's a qualified and non-qualified? If I Google that.
Huh?
What's a qualified and non-qualified?
Okay.
Where do I look?
First of all, no cash. Non-qualified plan. Shoot, where does it say? Qualified achievement. Tangible personal property awarded to an employee as a meaningful presentation for a safety achievement or length of service. Tangible personal property does not include cash, so it can't be personal property cash, meals, vacations, lodging, theater, sporting, stocks, bonds, anything. A qualified plan is an employee achievement award provided under the established written program that does not discriminate in favor of highly compensated people. That's the qualified plan. A non-qualified plan is anything else that's not qualified. So you don't have a written plan. If you have a written plan that says, we are going to give, maybe a TV set to the employee that has the best safety record. Any employee is eligible for this. Okay. Other business expenses. Depreciation. We're going to talk about depreciation in 2 weeks. No, next week. You're going to get your fill of depreciation. But it's good stuff. Okay, startup. What does startup cost? All those expenses before you start your business to get your business ready to start. Okay, you can write off the first $5,000 expenses the first year, and other than that, you have to amortize them over 180 months, 15 years. Okay, you have organizational cost. Legal fees to prepare, file for a partnership agreement, incorporation of a business. Those are all organizational costs. You got $5,000 there. So, and the same 15 years, 180 periods. So if you're in the middle of the year, you'd only get 6 months the first year, and then you'd keep going along till you used up your 180 months. If they go over $50,000, the phase out is completely separate for both startup and, okay, is reduced but not below zero by the cumulative cost of startup expenditures that exceed 50,000. So if you exceed 50,000, you start phasing out your 5,000. What does that mean? By the time you hit 55,000, you're at zero. You reduce it dollar for dollar till you get down. So then all you could do is write off over 18 years. 18 months. Well, 180 months or 15 years. Sorry. I'm getting teeny in my old age. So every time you have somebody that comes in and goes, hi, I started a business last year and I got $5,000 worth of expenses. I go, well, when did you start your business? I started on February 1st. And wrong answer. So last year, all those expenses, they can't write them off last year. They didn't start their business till this year on February 1st. So those are startup costs that on February 1st, they can, if it's $5,000 or less, they get to write the whole thing off. If it's over 5,000 and under 50,000, they get to write off 5,000 immediately and amortize the rest. Same thing with organizational cost.
Sorry, what is the start date? The day that you register your business?
No, the day you open it for business, start selling stuff. So, I have people that have started a business. They went down, got the GE tax license, they did everything. Then they did it at July 1st. But they didn't ever get the business up and running and didn't make their first sale till February the next year. Then they didn't open their business, they didn't start a business. If you don't start selling, the first question I ask, when did you start making money? When did you start selling your stuff?
And that's what you would put as a start date?
Yes.
If you apply for an EIN number or whatever?
No, applying for a number doesn't do anything for you. You could have your business going for 3 years and never applied for the EIN. Of course, you're going to get in trouble when you finally do. And you can say, oh, I'm an S corporation, but you never filed for corporate papers, you never filed for an S corporation. Oops.
Oh, Lord.
But you were in business, right? And what were you? If you were just one person, you were a sole proprietorship. If you were two people, you were a partnership. You were never a corporation or an S corporation. But then you might want to become one soon. Just guessing. Okay, vacant land. Interest and taxes on vacant land are deductible. Demolition. I have a house or something on that land. I want to destroy that to, your question or just?
On vacant land, but Hawaii doesn't allow you to deduct.
What do you mean? You have vacant land and you have property tax on it?
Yes.
You can write that off.
Okay.
That's still property tax.
Right.
Property tax. Now, I have